Now for credit spreads, the complete opposite mentality. You are not the option buyer anymore. Every time you're trading right now, you're buying, naked calls, naked puts, you're buying debit spread call or puts, bearish or bullish, you are the option buyer. For a credit seller, so credit spreads, you are the option seller. So this way, the way I think about it is you're basically the casino in the sense, and you are selling a sucker a dream. You purposely want to find, so let's just say, all right, I find a really hard support. We already know 100 is a super hard support and 102. So this is where I'd be structuring it. So let's just do this one and 100 and 102. So actually that looks absolutely atrocious. Let's do something, maybe something like that. There we go. All right. So in a sense, it's basically saying, I don't think AMD is going to go under 102. As long as it's, not in this box by expiration, I'm going to receive full credit. So now, just what this means is you are putting a collateral, just to make it easy, you are putting a collateral up front of $150. You are able to receive this money back if you are correct. So don't think, you're paying $150 to get $50. A lot of people think that and they're like, holy shit, this is trash. Why am I doing this? That is not the correct mentality for this trading method. If you are correct and AMD does not, is basically, if you are correct and AMD is above $102 by your expiration, you will collect full buyer's premium. So this is the buyer's premium. So if you are correct and AMD is super bullish, let's just say, fast forward, AMD is at $110, and it's above the strikes you're selling at, you will keep your full collateral that you put up front, $150 back, and you will take the maximum profit, the $50 of the buyer's premium. Now, also, pro tip, you are basically selling, you're structuring it so instead of a buy, you are selling, well, technically buy, sell, you're doing a sell buy. So you're selling the first 102 put, and then you're buying the 100. So this way you're opening it as a sell option. So this is how you're a sell, you're selling premium in a sense. You're the option seller. So this is completely different from option buying. You are acting as a casino in this case, and you purposely want the contracts that you are selling to expire worthless. This is the whole strategy. You want it to expire worthless on purpose because this is passive income. You purposely find, now this is what it is called is a put credit spread. It is bullish. You are bullish on a put credit spread because you think AMD is going to go up. You think it's going to go up. So you purposely find a very large area of support region, in this case 102 and 100, and you sell below it. So you sell below the 102 to structure it that way. So now if AMD is above 102 by time of expiration, or at least near expiration, you are able to collect full premium. Now, something that I need to address, it does not matter. So let's just say, all right, let's just say something catastrophic happens overnight. And if you structure it right this second and you buy it at 106 for the credit spread, right? And let's just say, the market tanks overnight. It does not matter if it comes down here. You don't lose just yet. What matters is if it's coming close to expiration and if it's still down here, yes, you're going to lose your money. But if it's able to, go back up, it doesn't matter. Just because it fell back down here does not matter. You're still okay to go. It can do whatever the hell it wants. It can go sideways. It can go up, down. As long as by your expiration, it's above your strikes. So basically above 102, you will collect buyer's premium. Now, there is one instance and one instance only where you should let your expiration expire. So basically, general rule of thumb for credit selling, Same mentality for debit spreads. You want to be taking your profit at 70, 80%, just because, you don't want to be messing around with the extra 20%. It's not worth it. This is a passive income strategy. So 70, 80% over and over and over is more advantageous than collecting that full 100%. The only time you let it expire worthless. So basically, you don't sell it, you don't do anything with it, you let it completely expire and you don't even touch it, is if the contract that you're selling is way, way lower or above. So in this case, it's got to be way lower. So let's just say AMD shoots up to the moon and it's like, $110 by near your expiration, right? Clearly, there's no way in hell it's going to be $102 by, 2 days from now. That is your only justification. If it just super bullish in this case, that is the only reason where you should not touch your contracts and you should just let them expire worthless. And that is the only way you will collect full maximum profit, right? Now, if it's sketchy and if it saves at like maybe like 105 or something like that, 106, so it's kind of above your strike but not super above your strike, that's when it's better to just take profit at say 80 or like 70 or 80% and just redo it over and over and over again, because you are able to do these on a weekly basis or a bi-weekly basis. At most, I would do a monthly basis. Never sell credit above a monthly basis. It's not really advantageous because you want to be doing this on a short-term basis. You want to be doing this over and over and over again just to kind of make passive money. Because yeah, this looks like shit, but let's just say you buy 5, right? And now this is a monthly contract, obviously, but let's just say this is a weekly contract because you can still get the same risk rewards on weekly contracts. But for this example, let's just say it's a weekly. Do this once a week, 4 weeks. You're making an extra $1,000 for doing literally nothing besides selling a buyer a dream. That's all you're doing. So how to do this is find a super strong support level. You open some spreads below it. You sell some premium below it. As long as the stock price is above your your area where you're selling at, you can keep doing this over and over and over because you're able to collect your collateral back that you just put up, and you keep your buyer's premium. So if you do that 4 times correctly in a month, you just made an extra $1,000 that you did not have before. And all you do is you get into the trade, you set an alert, and you close it. If it comes by your alert, obviously then you got to be wary. Hey, how's the technicals looking? Does it look super bearish, or does it look like it's going to bounce? If it looks like it's going to bounce, set another alert, close your charts. If it looks like it's going to be bearish and drop on you, close it. Don't risk it. Just close it and do another one. And then set an alert to the upside. If it comes off on the alert to the upside, you have no reason to sell it because it's way above the strike you're selling. So you literally find a strong support. For this case, for a put credit spread, which is bullish, find a super strong support, sell underneath it, sell some buyer a dream that's not going to expire. It's going to expire worthless on purpose. You want it to, and then close your chart. Set some alerts, close your chart. That's it. Do that a couple times a month, and you'll make extra income. It's pretty simple. This is how I make passive income. I do this on either a weekly basis or a bi-weekly basis. Even if you can make a couple $100, right? Like that's still better than you had before from doing, in a sense, literally nothing. So don't look at it saying, holy shit, this is a horrible risk to return ratio. Not really. Like it looks bad, don't get me wrong, but if you sell it further out, the further out you sell it, in a sense, the safer it'll be. So like look at this risk reward. This is worse, but your probability is actually better. So the probability of the other one was about 65%, I think. This is 73% of it hitting, actually, of it expiring worthless. So this is even further down. So basically, yeah, this looks terrible, but the further out you sell is the safest way. So you don't want to be looking for, so this is a 4-to-1 ratio, 4-to-1, and the one we did before was a 3-to-1. Right? So those are the ratios you want to be structuring. Just because this looks really good, something like that maybe. That looks really good. But look at the probability. The probability is not on your side and it's really risky, right? So don't be looking for 1-to-1 ratios or 2-to-1 ratios when selling credit. That is risky. You don't, this strategy is not risky. You're not supposed to be risky with the strategy. You're supposed to purposely sell something far out of the money so it doesn't hit. Like that is the strategy. You're supposed to sell it out of the money so it doesn't hit. So the 3-to-1 risk to reward ratios and the 4-to-1 risk to reward ratios are um, safer. So they're, you know, the risk reward might not be as ideal as you want, but they're safer. So the probability is more on your side to actually, you know, hit. Now, same mentality, I will risk at most 50%. So in this case, I'm only risking, you know, like 300 some dollars. So the way I look at it is I'm not in a sense risking $750 because obviously I'm going to use a stop loss. So I'm only risking in a sense $300 or so to make 250. So that, think of it that way, because that way is a, you know, a much better probability and risk reward ratio for you, because clearly you're not going to let this a complete, you know, expire and lose $750. You're going to cut it early if it's not going your way. So don't think of it like that. Think of it as, you know, maximum 50% stop loss. So that's your maximum you will lose. And then so that's put credit spreads. So call credit spreads, pretty much the exact same thing, but just flipped. So you are bearish on call credit spreads. You are bearish. So instead of looking for large support regions, you're actually looking for large resistance regions and selling above it because you don't think the stock is going to reach that. Same mentality, just flipped. So look for 3-to-1 or 4-to-1 ratios, sell a sucker a dream, do that weekly, bi-weekly, or monthly, just over and over and over again, you know, make some passive income. Any questions? Also, before I forget, spread trading is a margin account. If you are on a cash account, you cannot do this. So I would highly recommend opening, if you are interested in these trading strategies, I would recommend opening a margin account, whether it be with Tastyworks, Thinkorswim, you know, anything that you think would be interesting. I highly recommend Tastyworks for spread trading. It is honestly one of the best user-friendly platforms for it. So I can help you guys, you know, look into that. If you need me to, just send me a DM. I can help you, you know, with the platform if you have questions about it. But if you're interested in the strategy, I would open a margin account either with Tastyworks or Thinkorswim. Thinkorswim is, you can still do spreads with it. It's just not as noob friendly, truthfully. Whereas Tastywork is, it's really, really simple of a layout, and it just gives you all the information like right there with it. And also people are thinking, oh, margin account, isn't that bad? It's bad if you are, in a sense, day trading, which we are not doing with spread trading. We are swing trading with spread trading. And it's perfectly okay to have multiple accounts. I have a cash account, I have a margin account, and I have a shares account. This way, it's also even, it's better for your taxes if you split everything up. So just for a pro tip. Any end class, thank you guys for listening. I appreciate it.